When working overseas to support family back home, every single dollar carries weight. You must ensure the money you send covers bills without bleeding value. Recently, a distinct trend has emerged among Egyptian expats. Rather than sending dollars directly home, many choose to exchange their money into Egyptian pounds while still abroad, using foreign banks. The logic driving this choice is entirely ideological. By converting currency outside the country, expats aim to withhold foreign liquidity from the Egyptian central banking system as an economic protest against state policies. At the center of this strategy is the raw asset you earn, the US dollar. It is highly liquid and globally in demand. And on the receiving end is the asset your family actually needs to survive the month, the Egyptian pound. But we need to look at the actual mechanics of this transaction. We must ask if this strategy is executing a successful macroeconomic strike or quietly draining the purchasing power of your own hard-earned money. To find the answer, we have to strip away the political emotion and look strictly at the financial math of international exchange rates. This table shows the contradiction of exchanging abroad. Left is the official domestic rate inside Egypt. Right is the rate offered by a foreign bank. While the official Egyptian rate is 48 pounds to the dollar, a foreign retail bank might quote you just 40. You lose 800 pounds on a single $100 transfer before it even crosses a border. Over a year of consistent support, that gap compounds into tens of thousands of lost pounds. Ignoring the mathematical reality of exchange rates turns a political statement into a severe, unforced financial leak for your own family.
Let's break down exactly why you lose so much value when you choose the first and most damaging transfer method, converting dollars to pounds directly at a foreign retail bank. You have to look at this transaction from the perspective of a Western financial institution. To them, the Egyptian pound is not a standard, easily tradable asset like the euro or the yen. Because global demand for the pound is low, foreign banks apply an exotic currency spread. An exotic currency spread is the massive premium a bank charges to mitigate their own risk when handling a currency that is highly illiquid on the global market. They protect their profit by giving you a terrible buy rate. This waterfall chart tracks a single $100 bill as it moves through a foreign banking system. We start with your full $100 at the top. Instantly, the bank takes a 10 to 15% cut to cover their exotic currency spread risk. Next, because physical, illiquid paper money is difficult to move across borders, the bank applies a secondary structural penalty to cover their logistical and processing fees. By the time the transaction is complete, the stack of Egyptian pounds your family actually receives is drastically smaller than what the local official rate would have provided. The protest tax effectively funnels your capital into the profit margins of a foreign bank, leaving the Egyptian state's balance sheet entirely untouched. The second common transfer method involves using digital remittance apps like Western Union or Instarem, leaving them on their default settings. If you leave the app toggle to Send USD, Receive EGP, you are allowing a digital middleman to bake their own hidden margin into the conversion. You get a better rate than a physical bank, but you still leave money on the table. The third, mathematically optimal method requires stripping out the middlemen entirely. You send the funds strictly as raw US dollars. Sending raw dollars completely bypasses the foreign exotic spread. It forces the conversion to happen inside the local Egyptian economy, guaranteeing you capture the highest official exchange tier available. There is a trade-off. Your recipient in Egypt will have to physically take the raw dollars and execute the exchange locally at a bank or certified office. But delaying the currency conversion until the absolute final local mile is the only proven way to maximize your family's actual purchasing power. We can map out exactly how these different transfer decisions dictate the actual value your family receives. This quadrant chart plots your options based on two factors: the total financial value your family keeps and the amount of effort or friction it takes for them to get it. The foreign bank route sits at the absolute bottom. It offers the lowest possible value to your family while still creating high logistical friction. The default app transfer is a compromise. It creates very low friction, but limits the financial return. Sending raw USD is the optimal financial strategy. It introduces moderate friction for the receiver, but guarantees the highest possible retained value. Operating on emotional politics drops you into the lowest value quadrant. Operating on objective math maximizes your capital. For practical family support, your directive is simple. Whenever you use a transfer app, manually force the setting to receive in USD. If you are acting as a wealth preserver, your best route is transferring raw dollars directly into a domestic, dollar-denominated account inside Egypt. By holding your savings in dollars, you completely insulate your capital from local inflation. You only convert to pounds at the precise moment the liquidity is needed, at the current highest rate. A $100 penalty disappears within a multi-billion-dollar national economy, while directly compromising the financial security of the person waiting for that transfer. True financial empowerment comes from cold, calculating capital efficiency. Don't pay the costs of a misdirected protest. Manage your money with math, not emotion.